Good morning, everyone, and I would like to welcome you all to FinTedu's webinar on the recent VAT regulation updates, which have once again brought VAT into the spotlight. And for this webinar, we are honored to have two prominent tax experts with us. First, we have Jesus. He's the head of indirect tax at a family group with over 29 years of experience in indirect taxes and tax technology. And joining him is Vlad. He's an indirect taxes partner at WTS Thruva with over 17 years of experience across UAE, UK, and New Zealand. Before we dive into the discussion, let me quickly introduce myself. I am Anu, co-founder of FinTedu. Thank you once again, everyone, for joining us. Let's get started. Vlad, over to you, please.
Thank you, Anu. So, hello, everybody. My name is Vlad Skibunov, and as Anu has mentioned, I'm a partner in WTS Thruva. Finally, it's an exciting time to be a VAT consultant again. After 7 years of minimum changes to the VAT legislation, we do have some substantial amendments. Since we do not have that much time today, I will jump into discussing the changes which I'm covering in a second. But before we do that, I did want to note one thing, is that typically when this type of substantial legislative changes are introduced, the FTA issues public clarification on the changes, where it discusses the amendments and often it provides interesting insights into how to interpret them. And why is it important? It's because, as we'll see today, there are still a number of ambiguities when we're looking at certain provisions. And therefore, the FTA guidance would be important to clarify them. And hopefully it will be public guidance issued through public clarification over the next few weeks. Anyway, so let's start. What I am discussing today are Articles 30, 31, 42, and 46 of the amended Executive Regulations. And we'll start with Article 30, which is an article which governs the export of goods, specifically zero rating of suppliers of goods which are exported out of the UAE. And what happens currently is that in order to zero rate the supply of goods for export, a number of conditions have to be met. And one of those important conditions is that the supplier has to obtain and retain official and commercial evidence of export. And it is this requirement to obtain and retain the official evidence of export that has been causing most of the problems in practice. And the key reason for it being a problem is because the FTA never actually publicly announced what it considers to be an official evidence of export. So many suppliers would interpret it as, for example, being a customs declaration. But that's not the case, because what we do know from a number of private clarifications issued by the FTA, as well as decisions which they have taken during tax audits, is that by default, the FTA considers that exit certificate is the only document which evidences that the goods have left the country. And therefore, in order for a supply to be zero rated, the supplier has to obtain this exit certificate. If for some reason it is not able to obtain it, then it should be asking for admin exception, but otherwise it is a requirement. And therefore, FTA often does impose penalties when it audits taxpayers and realizes that they are zero rating exports of goods without actually having exit certificate. But luckily for everybody, the FTA has now understood that it is a bit of a problem. And the amendment which is made to Article 30 now introduces a number of other options which can evidence the export of goods and will be acceptable type of documentation from the FTA's perspective. So they're listed here on the slide. So the first two are what is important for goods when they actually leave the country. And it's two sets of documents which are now being optional as an option for the supplier if they want to zero rate the supply of goods. So first set of documents is customs declaration and commercial evidence. And the second set of documents is a shipping certificate and official evidence of export of goods out of the UAE. The third option is for when goods are sold and then moved into customs suspension regime in the UAE. We'll not discuss it in much detail now because it's quite limited application compared to the first two options. So option one in Article 30 is for the supplier who is selling goods and those goods are exported, and assuming all other conditions in Article 30 are met, is to keep customs declaration and commercial evidence of export. Customs declaration is not defined in the legislation, but it's a normal document which will be issued by the relevant customs authority. Commercial evidence of export is now defined, and it's an interesting definition because it says it's a document issued by transport companies and agents which prove the transfer and departure of the goods from the UAE and includes any of the following documents. And here we have air, sea, land, waybill, and manifests. Why it's an interesting definition is because we see in the introductory part that it says it proves the departure of the goods out of the UAE. But at the same time, the list of documents which they have expressly provided here does not always prove that the goods have actually departed, because you may have a situation when you do have this document, but the goods then did not leave the country, and you still have a copy of that. The question is it sufficient? And the working assumption currently that yes. Considering that the legislation here specifically mentions that it includes airway bill and manifests, sea and landway bill and manifest, it should be assumed that this, if you retain this type of document, it should be sufficient for you as a commercial evidence of export. Obviously, if the supply was cancelled, if the goods were not exported, you should not be zerating in any event. But hopefully this is something what potentially will also be clarified beyond doubt by public clarification, which I previously mentioned. So this is a first set of documents which gives you which meets the requirement for the proving that the goods have been exported. The second one is a shipping certificate and official evidence of export. And both of these terms have been defined in the legislation. The shipping certificate has been defined as a document issued by transport companies as an equivalent of a commercial evidence where the commercial evidence is not available. And official evidence has been also defined, and in summary, it will include official documents issued either by relevant UAE authorities, which prove that the goods have left the country. And once again, this is probably going to be the exit certificate because it is the document which proves that the goods have left the country. But alternatively, now you can also retain and obtain the official evidence from the custom authority of the destination country that the goods have entered there. So if you have that type of proof, it also meets now the requirement of official evidence of export. So we see that between these two sets of documents, we have much broader dispensation, the permission from the FTA regarding what kind of documents are acceptable in order to meet the requirements under Article 30. Just one interesting thing which I did want to note here is that it does appear that the way it is drafted that you have to keep either customs declaration and commercial evidence or shipping certificate and official evidence. And why it's interesting is because commercial evidence is effectively, as they're describing it, an alternative to shipping certificate. So you should technically be able to keep commercial evidence as they define it, for example, airway bill and official evidence, and the requirements should still be met. But the legislation is drafted in a way that requires you to keep shipping certificate, which is alternative to commercial evidence, which does seem to be, to me, quite counterintuitive. It should not really be the case that you need to ask specifically for shipping certificate if you already have airway bill, but that's the way it's drafted. If it was something what's not intended, hopefully it will again be clarified in that public clarification, which I mentioned by the FTA. So now we're moving to the next article, which I want to discuss. Is Article 31, which governs the exports of services. So as we do know, the exports of services can be zero rated, and by export I mean supply of services for export can be zero rated when a number of conditions are met. And the main conditions are contained in Clause 1A of Article 31. And until the current change, those main conditions were that the supply of service is made to a recipient who is not resident in the UAE. The recipient is not present in the UAE at the time the services are performed, and that is subject to a number of exceptions. And that the services are not supplied directly in connection with any goods or real estate in the UAE. So if you're meeting those conditions, up to now, the services could have been zero rated. There is also another exception in Article 31.3, but we're not discussing today. Now, this has now been expanded. So the FTA has now introduced a new condition in subclause 3, where it says services should not relate to or should not be treated as being performed in the UAE on a designated zone under Articles 33 to 8 or Article 31 of the decree law. And what those articles do is they provide for special place of supply rules. So I listed them here. It's special place of supply rules which target services which are consumed or utilized in a specific location. So for example, services provided on goods, on real estate, catering services, hotel services, events, those type of services are normally consumed in specific location, and therefore we have a special place of supply rules for those type of services. So before this particular change, there was no specific exception from zero rating where the services have been deemed to be performed in the UAE on a designated zone under one of these provisions, under one of these place of supply rules. But at the same time, if we look at the application of the conditions which did exist in Article 31.1a before the change, many of these type of services would have been excluded from zero rating in any event. For example, services provided on goods or on real estate, they would be excluded from zero rating due to the application of clause A2, which says that your service should not be directly in connection with goods or real estate. Services provided in respect of some event happening in the UAE or catering service happening in the UAE would also have been potentially excluded from that zero rating because of condition in subclause 1, which says that the recipient should be outside the UAE when the service is being provided. Therefore, for many types of services, this particular provision doesn't actually impact it. But at the same time, it's a good clarification in the sense that now it makes it much clearer what the rule is. So you do not need to go through analysis whether or not you can zero rate a specific service with a place of performance here. Once you know that you determine your place of supply under any of these articles, you're not able to zero rate under Article 31 anymore. And potentially there have been some services where you could say you could identify some scenarios where even though they do have place of supply under this type of provisions, they could have been zero rated. For example, I'm thinking about some electronic service where the contractual recipient might be outside the UAE, but the use and enjoyment is in the UAE. And you could find situations when it is arguable that that particular service could have been zero rated under Article 31, but now it will not be. So moving forward, two important changes to Article 32 of the Executive Regulations. So Article 32 is the provision which deals with the financial services and the exemption of financial services. And the way the article is structured is that Clause 2 of Article 42 provides a list of services which are treated as financial services. And then in Article 42, Clause 3 and Clause 4, it also specifies that there are certain types of these financial services which are always exempt, but when it's not listed as specifically exempt, then the rule is that if a service is provided in return for an explicit fee, then it's taxable. If it's for a spread, margin, or some kind of implicit fee, it is exempt. So there are a couple of changes to this particular provision, to Article 42. So first of all, we're going to cover fund management services. So now Clause 2 has been updated to include fund management service within its definition. So now fund management service is one of the financial services for VAT purposes. And this particular definition is quite interesting. So what it does, and you'll see it here on the screen, under Clause J, is that it says it's a service provided by fund manager to funds licensed by competent authority in the UAE, including but not limited to management of fund operations, management of investments for on behalf of the fund, monitoring and improvement of the fund's performance. So immediately we see an interesting requirement here is that it has to be a fund licensed by a competent authority in the UAE. And the question which immediately comes to mind is, what is this competent authority? What kind of license is required? So this is still one of the uncertainties with this particular provision, because it may be interpreted as a fund simply has to have a commercial license somewhere in the UAE, and therefore it will be included. Or it may be the requirement that has to be regulated by a certain financial body, and in which case we do need some specific about what type of regulatory body it is and what kind of license you need to have. But once you fall under the definition, so as a fund manager, if you are supplying the investment fund management services, clause 3 now specifies that those type of services are exempt, and they'll be exempt from 15th November 2024. So it's not that it can be taxable if it's for explicit fee and exempt if it's for implicit fee. No, it is always exempt. So what does it mean? What does it mean for fund managers, and what does it mean for the funds? So by making exempt supply, the fund managers do not need to charge VAT on those supplies anymore, which is obviously a fundamental shift from how it has been treated until now. Because until now, the fund management services have been fully taxable. And since they were fully taxable, it is a cost to the fund. And typically fund, because they're not engaged in any taxable activity, cannot recover VAT, which they incur. Therefore, by changing the treatment, by exempting fund management services provided by fund managers to the funds, this particular amendment effectively removes the irrecoverable cost of VAT from the funds. So now funds have this extra money to invest into their investment activities. But at the same time, it does have impact on the fund managers, because as we know, an exempt supply, you're not able to recover input tax which you incur in respect to the exempt supply. So effectively, therefore, it shifts the VAT cost, irrecoverable VAT cost, from funds to fund managers, because fund managers will still incur certain expenses. Those expenses will be subject to UAE VAT, and they will not be able to recover those particular VAT on those particular expenses to the extent that it relates to the exempt activities. And therefore, what fund managers will now have to do, they have to assess what to do with this irrecoverable VAT cost, because either it will hit their profit, they'll just take this hit, or will they gross up their fund management fees, which they then recharge to the funds by this amount of recoverable VAT. So every fund manager will have to now make cost-benefit analysis of what to do with this recoverable VAT cost, and sometimes it is also a commercial or contractual decision whether or not they are able to recharge this particular cost, or whether or not they just have to take the hit. Obviously, since fund managers may still have some taxable activities, common costs will need to be apportioned. So if they have some costs which relate to both exempt activities and taxable activities, for example, normal office costs, they need to start apportioning that under the input tax apportionment rules. The next thing to note is that the definition, as we discussed before, is specific. It's only applies on services provided to licensed funds. So once we have this clarification from the FTA what licensed fund means, if you do supply investment management services to funds which are not licensed, then it is not treated as a financial service, and therefore those type of services still remain taxable at 5%. Now, for certain funds, there will be question, do they need to register from VAT? So if a fund, by fund manager, if the fund manager only makes exempt supplies and does not have any taxable supplies, then they can register from VAT. The fund managers do have to take into account, however, whether or not they import any services, because import of services does count for the purpose of VAT registration threshold. And if they do have to remain registered based on import of services, they'll also have to account for VAT under the reverse charge mechanism. And as we discussed before, they would not be able to recover that input tax because they do not have any taxable supplies. And finally, on this particular point, where a service is provided to a fund which is resident outside the UAE, the fund manager can still consider whether or not they can zero rate it. So under Article 31, which we discussed in the previous slide, there are certain conditions which have to be met, but both taxable and exempt supplies can benefit from zero rating if conditions in Article 31 are met. So the next big change which was made to Article 42 is in respect of virtual assets. So first of all, the virtual asset has been defined in Article 1 of the regulations. So the definition is that it's a digital representation of value that can be digitally traded or converted or invested, but does not include digital representation of fiat currency or financial securities. So now we have this definition of virtual assets, which effectively covers NFTs and cryptocurrencies. And the dealing with this type of virtual assets is now also included in Article 42 as one of the financial services. So Clause 2 has been updated to include 3 new subclauses, K, L, and M, which includes transfers of ownership in virtual assets, conversion of virtual assets, and keeping and management of virtual assets. The important consideration is the next one. So Clause 3 of Article 42 now states that transfer of ownership and conversion of virtual asset is exempt from VAT. And it's exempt effective 1st of January 2018. So for the last 7 years, we had a situation where there has been total silence in respect of VAT treatment of virtual assets such as cryptocurrencies. And the taxpayers, the businesses have been adopting different tax positions. Some treated as exempt, some treated as outside the scope, some treated it as taxable because there was absolutely no guidance in the UAE. Similarly, for input tax, some businesses may have recovered input tax on the expenses, some may not have. Now we do have this clarification from the FTA that transfer and conversion of virtual assets is exempt and it is effective from the beginning of VAT. So what it means is that taxpayers should not have charged any VAT on this type of dealings with virtual assets for the last 7 years, and they should also not have recovered any input tax in respect of any related expenses. So what will be really important now for businesses in this particular industry is to review their treatment since January 2018 and consider whether or not it has been correct. Do they need to do any voluntary disclosures, and what is potential impact of that? Because it might be if you have recovered input tax, if you find yourself in a position where you have underpaid VAT or over-recovered VAT, then you might be subject to penalties. So another important point here is that only transfer of ownership and conversion of virtual assets is exempt. Keeping and managing and enabling control of virtual assets is not specifically exempt. So what it means is then those type of services default into the general rule for financial services, which is that if it is for an explicit fee or consideration, then it is taxable at 5%. If it's for margin spread implicit fee, then it is exempt. And the final point I want to mention here is this. If you look at the definition of virtual asset, it does exclude digital representations of fiat currencies and of financial securities. And it will be interesting to see what is really meant by that. Is it simply CBDCs, so central bank digital currencies, which are representation of a real fiat currency? Or is it also meant to include stablecoins, which are cryptocurrencies which are pegged to another currency? I would think that stablecoins should be included into the definition of virtual assets because they're not strictly representation of fiat currency, even though they're pegged to it. But hopefully, again, this is something what FTA will clarify really soon. The final change I wanted to discuss was Article 46. And Article 46 tells us what is the impact from a tax perspective when you identify that you're making a single composite supply. So before actually talking about a change in Article 46, we need to understand what are the scenarios when a single composite supply may take place, may exist. And this is defined explained in Article 4 of the Executive Regulations. So in summary, a single composite supply may exist when you have a principal component and some incidental supplementary components which enable that principal supply. And the second scenario when a single composite supply may exist is when you have two or more elements or components which are so closely linked with each other that they're impossible or natural to split. So Article 4 tells us when a single composite supply does take place. And Article 46 is meant to tell you, okay, now you identified identified a single composite supply. How do you treat it from VAT perspective? And before this amendment, we did not have the subclause B. What we essentially had was subclause A, which told us that when you do have a single composite supply, the VAT treatment of the supply should follow the VAT treatment of the principal component. But as we see from Article 4, there might be scenarios when you don't have a principal component, when you have a number of elements which are equal in value, equal in importance, but you're still not able to split them. And therefore, this new Clause B is meant to deal with the situations when you do have the second scenario. So when you have a single composite supply, which does not have a principal component, the VAT treatment should be determined based on the nature of supply as a whole. Some people may say it doesn't help that much because we do still need to identify what is this nature of supply as a whole, how do you determine it? It will obviously be based on case-by-case basis, and you'll need to consider what type of supplies you're making. An example I'm thinking about right now is, for example, if you take a tour operator selling a tour package, which may include some local transportation, which is exempt within the UAE. It may have a zero-rated flight from UAE somewhere else, and it may have hotels, excursions, and other types of activities abroad, which are outside the scope. If we treat this as a single composite supply, we do need to identify what is the VAT treatment of that particular supply. Is it exempt? Is it zero rated? Is it outside the scope? And again, this is just an example, but I would think that considering that most activities will be performed outside the UAE, you could potentially say it should be outside the scope because, let's say, my trip is for 2 weeks somewhere else. So most of those activities, most of those components will be outside the scope of UAE VAT. So the whole supply would be outside the scope of VAT. Again, this is just an example. You do need to look at your specific scenario, at your specific single composite supply, but look at it holistically and see what is the VAT treatment. So that is the end of my presentation. I'll pass on back to Anu and Jesus.
We can start with your presentation now.
Good morning to everyone. Then I'm going to continue the intercases presentation, but very focused on Articles 53 and 54 that are focused on developments on the recovery of input VAT, and I think that there are two very relevant developments on this type, and on Articles 15, 59 and 60 that are with respect to the issuance and generation of tax invoices and credit notes. I think that there are also relevant developments, and that's the reason we are focusing on these articles. Then with respect to Article 53, I think that everybody is aware of this development, and what it is clear is that it seems that the FTA decided to flexibilize the regime of the input VAT on medical insurance services, and in that case, what the new, let's say, the new clause that has been introduced into Article 53 in particular in the clause 1 of this article is establishing that in that case, are deductible the input VAT incurred by the employee on when obtained health insurance services for their employees. Then the question is under families. Then the dependents are within the scope, and the question is that which is the threshold that the new wording of the regulations is establishing. In that case, the limits are, as many of you already know, is the one spouse and 3 children. okay, under the age of 18 years. Within these limits, the input VAT on the health insurance is irrecoverable. Then I think that the main takeaway is that it seems that now we have an uniform the regime of the input VAT deduction of these expenses has been, let's say, harmonized in all the Emirates, in all the federation, and this is a good news. And with respect to the traditional regime of the Northern Emirates, the new rule is more generous, and this will allow in the case many companies to recover additional input VAT that up to the moment in which this rule is going to be enforced on 15 November, they have been blocking the deduction of this input VAT. So the question of when this new development applies is, I think, that is important. Because why? Because there are no transitional rules. Then in practice, I think that now the challenge is evaluating each case, and saying questions like the cutoff, and of course the periodicity of the invoices, of the tax invoices that the taxpayers are receiving from their vendors of this type of services. I think that in that case, more or less, there are cases in which the taxpayers will be in position to request an split or a specific tax invoice to the suppliers, because in that case they will be on time. And the period is, let's say, is playing in their favor, and then they will, okay, please, may you generate a tax invoice only for the period from 15 November 2024 up to the end of the year. And in that case, of course, there will not be any problem to recover the input VAT. But we know that there are different cases, and this is going to be an important issue to be in the case studied case by case, because you know that we have many different cases on this. Then the following, I'm going to jump to the next development that, for me, from my point of view, is quite important, but is quite important to the entities that they have any kind of restriction on the recovery input VAT, because the rules of apportionment of input VAT that are in the Article 55 of the regulations. I think that there is a real cascade of developments that, from my point of view, are quite important and quite relevant for this type of entities that are applying the rule. The first one, it refers to specific cases in which the tax year could be, let's say, can be ended, no? And there are three cases in which the end of the tax year can be anticipated, may be different to the 31st December or the last day of the tax period, depending on the specific registration, the VAT registration characteristics of each one of the taxpayers. Then we have three cases. The first one, in the case that the taxable person cancels his VAT registration. Obviously, in that moment, there is an end of tax year. The second case, if the member that has a single VAT registration joins to a VAT group, in that case, also there is an ending of the tax group. And the third case, when the member leaves a VAT group. Okay, then I think that we should take into account that this rule is important. Why? Because we are going to see later, okay, the end of the tax year is quite relevant, because it's the period to be considered when we do the final calculations with respect to the apportionment of input VAT according to the clause 9 of the article. And in that case, as we are going to see, this has also a practical impact when we are going to see the new wording of the clause 12 and this threshold, this limit of 250,000 dirhams that we have to adjust depending on the circumstances. And so I think that this matter is important because of this. Then the next amendment that, from my point of view, is important is the amendment on clause 6b of the article. Why? Because now I think that the FTA is clearly including the VAT that is non-recoverable according to Article 53 and on the amounts that are which input VAT, okay, is recoverable as per Article 54 and 57. Okay, so these amounts are not included from the beginning in the calculation or in the input VAT amounts that are eligible to any kind of VAT recovery. And it is very important, I have highlighted that the regulations are including finally the Article 57, okay, the Article 57 of the decree law, and why? Because this let's say that this article, remember, was introduced in 2022 when the Federal Decree Law 18/2022 was introduced, and it is establishing the recovery of VAT for government entities and charities. Then now the Article 57 is appearing, fortunately, in all the wording of in different clauses of Article 55, and is clarifying this matter because there was a development in the law that was not, okay, is still introducing the regulations. Now this matter is solved thanks to this development. Then another important, I think, amendments is in the clauses 6C and 7 of the article. I think that are impacting in the way how the recoverability of the residual input VAT is calculated. Okay, first of all, why? You know that the wording is still in application until 14 November 2024, is saying that you are calculating, no? You from one side you are calculating the input VAT that is recoverable, and you are comparing you are dividing by an amount in the denominator that is the sum of recoverable VAT tax and non-recoverable tax for the tax period. Then, as you see, the word tax period is important, as I mentioned before. But now the wording has changed, and instead of the in the case the sum of the recoverable tax and the non-recoverable tax, it is talking about sum of input VAT for the period. What does it mean? This means that suddenly there are amounts of non-recoverable input VAT because the application of Article 53 and, for example, input VAT amounts attributable to out-of-scope transactions that suddenly could appear in the denominator, and the impact of this is that the recovery percentage that is obtained and is rounded to the nearest whole number could be reduced. Okay, and and I think that I invite to many of you that start to review your calculations if you are in this case. Then finally, I think that this recovery percentage that, as you have seen, is reduced, is multiplied by the amount that now has changed, and according to Article 6b, fortunately, it is clearly establishing that it's not including in any case the amounts that are non-recoverable to Article 50. Okay? Then, from a technical standpoint, I think that there are relevant changes in the calculation of the input VAT apportionment. Apart of this, there is a new clause 12 that is adapting, no, to that threshold. This threshold, when we are doing the annual wash-up, and suddenly we try to compare the method that we are using if we are not using the general method, and there is a difference of input VAT of more than 250, then this adjustment, okay, has to be adapted to cases in which my tax year is less than 12 months. As we have mentioned before, these are the cases that we are seeing above in the class in clause 4. There are cases in which your tax period is less than 12 months because of the reasons that we have mentioned before. There is another I think there is another important development in clause 13, because in the case the FTA may in that case be in the case habilitated by the rule to request to the taxpayers that they change their calculation method of apportionment of input VAT, and they go for a special VAT method, okay, in the case that they understand that the taxpayers, the method applied by the taxpayer is not reflecting the actual use of the goods according to the input VAT deduction rule. And finally, I think that there is another interesting development with respect to the clause 16, that is establishing that the option for the taxpayer of applying an input VAT recovery rate based on the recovery rate of the previous year. Then I would like to remind you that this is a new option. Okay, you know that we have the default, okay, the general apportionment method that is the one that I have described before and is in clause 7. Then you can apply special methods as per clause 9 of the article, and now there is a new method that the taxpayer can apply to the FTA for the application of the recovery rate of the previous year. Okay, we should highlight that these special methods or these should be approved by the FTA, and in the case that they are approved, the taxpayer can implement them, and this option is applicable during 2 years. Then it's important in the takeaways also highlight that this measure is going to be enforced from 15 November, and basically I think that the main takeaway is, as I mentioned before, there are relevant changes in the calculations, and I encourage to everybody to review this by their own means or by their tax advisors in order to see how their apportionment of input VAT is impacted by these developments. I think that this is the main takeaway from my point of view. I think that let's see also if the FTA is going to clarify any one of these aspects, because I think that all these changes are quite technical, and of course I think that for example the new method of the article 16, I think that maybe will require any kind of development by the tax authority. Then let's go now for the changes that are related to the generation of tax invoices credit note. Okay, first of all, we go to the Article 59 is with respect to the generation of tax invoices. There are two important developments. Let's remind that the general regime in the UAE, according to the article clause 1 of Article 67 of the VAT law, established that the tax invoice has to be issued within 14 days from the date of supply. The regulations are establishing two exceptions to this clause according to the new clause of Article 59 that has been introduced. The first one is that with respect to the simplified tax invoices, they should be generated on the date in which the transaction is carried out. And with respect to the summary tax invoice, and this is important, is you can generate a tax invoice that includes transactions that are carried out during 1 month. In that case, the 14 days have to be computed from the end of the calendar month in which the transactions took place. There is another clarification in clause 5 of Article 59 that is clearly establishing that simplified tax invoices cannot be issued in the case of transactions under the rubber charge mechanism. And I think that I have marked this in red. Does it mean now is that the tax authority is saying that in the rubber charge mechanisms of Article 48, taxpayers should generate standard tax invoices? I think that there are different opinions with respect to this, and I think that there are arguments in favor of one and the other. But I think that this is a matter that, if it is finally confirmed, I think that it will imply that many people has to review their systems. But this is an implication that we are going to talk later. Then finally, with respect to the credit notes, the generation of credit notes, we have to consider that the FTA has introduced two technical requirements with respect to when multiple tax credit notes with respect one single tax invoice are generating, in order to, let's say, have the traceability of the final amount resulting of these tax invoices, and the second with respect to when a credit note is generated by an agent. Then it establishes in the case that both the principal and agents have to maintain the records, some specific records with respect to these credit notes. And I think that it is important also highlight that the FTA now is going to have authorization in order to control the the exceptions to the generation of tax invoices that they could grant to taxpayers, and also restrict the use of simplified tax invoices under Clause 5 of Article 59. Okay. Then these are cases in which the tax authority, they are establishing rules habilitating the tax authority in the case to take action in the case that they consider that the conditions for the application of these facilitations are not applicable anymore. Taking into account that these developments are also applied from 15 November 2024, we should take this into account in the different measures and in the impact assessment that any taxpayer has to do, because we know that this implies that an impact in the practices, in the invoicing practices of the taxpayers, and the most important, taxpayers have to review the systems, the billing systems and the EOPs, in order to ensure that all the developments that I have just mentioned are properly, properly calibrated, and the systems are aligned to the rules in order to avoid penalties. From my point of view, I think that I have finished.